that a yes? All right. And it does also just a reminder, *6 to mute your line again. So with that, good afternoon, everyone. Welcome to today's webcast on dividend investing. I'm Joshua Brockwell, Investment Communications Director here at Azzad. We're pleased to be joined today by our partners at SKBA Capital Management for the first installment of a multi-part series profiling the world-class portfolio managers in the Azzad Ethical Wrap program. SKBA manages the large cap value strategy in our wealth management program, and they're here today to share their expertise on dividends and the role that they can play in your portfolio. So let's move right along then to slide number 2. Here's a quick rundown of what we'll be discussing today. We'll spend a fair amount of time on dividend investing and SKBA's unique approach to that discipline. First, though, we'll introduce the presenters for today. As I mentioned, I am Josh Brockwell here at Azzad. Also joining us is Harris Anwar, who's an investment analyst at Azzad. Harris works with SKBA and the other firms who manage money for the Azzad Ethical Wrap program. They interact on a regular basis, dealing with everything from making sure portfolio holdings are Sharia compliant to performance evaluations and attribution analysis. Also noted on your screen are Josh Rote and Andy Bishop, who are portfolio managers at SKBA, and they are so team-focused that they elected not to have their likenesses shown today so as not to engender a cult of personality. It's all about team at SKBA. Again, SKBA manages the large cap value strategy in the Azzad Ethical Wrap program. Welcome, everybody.
Thank you, Josh.
Thank you. Good afternoon.
Hey, thanks, guys. And moving right along, a word from our sponsor. Just to give you some background on us, Azzad Asset Management, we're a boutique firm located just outside Washington, D.C., here in Falls Church, Virginia, registered with the SEC as an investment advisory firm. In addition to serving as independent financial advisors, we manage and sponsor 2 publicly traded mutual funds known as the Azzad Funds, which are screened using our proprietary ISFA methodology. Some of you may be familiar with the webcast we did last month on ethically screening your portfolio, which profiled our ISFA screen. If not, I'm happy to share that with you. But moving on, let me also mention here again that we are the sponsor of the Azzad Ethical Wrap program, a wealth management solution that brings together 6 institutional money managers from across the country, including our good friends at SKBA, and overlays their expertise with our ISFA screening process. And our dedicated team consists of chartered financial analysts as well as certified financial planners. I'll now turn the presentation over to Harris Anwar, our investment analyst here at Azzad. Harris?
Thank you, Josh. As members of the U.S. Forum on Sustainable and Responsible Investment, we at Azzad incorporate environmental, social, and corporate governance criteria into our investment analysis and portfolio construction across a range of asset classes. In addition, we put added emphasis on certain characteristics of socially responsible investing, in keeping with our philosophy of generating competitive, long-term financial returns while using investment capital to promote a sustainable economy and positive societal impact. The Azzad philosophy also means that our investments comply with halal investment guidelines, as established by the Accounting and Auditing Organization for Islamic Financial Institutions, or IOFI. Here is a brief overview of IOFI. This organization serves as the de facto standard-setting body for 90% of the Islamic finance industry. It is a consortium of scholars, thinkers, and experts in Islamic law dedicated to outlining the principles by which investing can be considered ethical and halal. Individuals represent 5 major Islamic schools of thought, and their guidelines are the backbone of our screening process for the portfolios that make up the Azzad Ethical Wrap program. As a corporate culture, we abide by the 7 tenets of halal investing. These rules serve as the foundation of our ethical philosophy and are formulated according to IOFI guidelines. They help us to grow our clients' wealth in a halal and responsible way. Now a word about the Azzad Ethical Wrap program and our team of world-class institutional managers. At Azzad, you get the unique advantage of having 6 quality managers under one roof, including SKBA. These managers handle a portfolio of individual securities based on their asset class specialization. However, their high minimums, often reserved for institutions, limit their access to retail investors, but with the Azzad Ethical Wrap program, we offer clients access to all of these managers. These managers each contribute to a strategy that we at Azzad then bundle into one of 5 asset allocations based on our client's risk tolerance and time horizon. Because it is made up of individual portfolios screened according to our criteria, each allocation is halal and compliant with Azzad's ISPA methodology. We oversee the managers and make sure that they remain faithful to the principles that we abide by. Building relationships with these managers is a process that takes much time and due diligence. We perform an in-depth assessment of a firm before deciding if a firm is eligible for inclusion in our program. Managers must also demonstrate a commitment to providing competitive performance within our socially responsible investment restrictions and their specific investment strategies. We continue to conduct ongoing rigorous due diligence on all our managers to ensure that their investment process continues to be a promising fit for our program. Our investment committee meets regularly to assess a manager's performance, review their portfolio, and discuss their overall contribution to our program. Managers are replaced if quantitative results no longer meet our qualitative expectations. Throughout the year, clients may participate in telephone conference calls to listen to our independent manager views on the markets. Their individual models are made available to clients through our 5 allocation strategies. Now that you know a little more about the Azzad Ethical Wrap program, let me turn it over to Josh with SKBA to talk about how dividends contribute to our large cap value strategy.
Thank you, Harris, and thank you, Josh, for the introduction. Andy Bishel and I also want to thank everybody at the Azzad team for letting us present today to you and your clients. We hope that it'll be informational. If we look at page number 12, who is SKBA Capital Management? The firm was founded in 1989. The founders and senior principals of the firm came from the Bank of California's Bank Trust Department. So when you think of the tenets of all of our equity strategies, they are really based on some of the desires and the requirements that a bank trust clientele may have with respect to capital appreciation as well as capital preservation. We've helped clients manage through a wide variety of economic environments over the last 25 years. And that really speaks also to the third bullet point here, which I mentioned a second ago, in terms of not simply looking at capital appreciation, but when we talk about risk, we view risk as the risk of permanent loss of capital, which we always keep an eye out towards. The last bullet point is a very important one to us in that back a couple of years ago in 2011, almost 3 years ago now, we repurchased a majority of our company back from our former parent, putting additional capital into the firm to increase our ownership stake significantly. We'd had a long-standing and good relationship with our partner. They remain a minority partner, but we wanted to make the statement of having additional skin in the game. So when we speak about being aligned with the interests of our clients, if our clients don't do well, we don't do well. Moving to page number 13, in terms of some of our investment-related attributes. Second bullet point of building valuable investment perspectives different than those of Wall Street. What do we mean by that? The next bullet point, we're not focused on quarterly earnings or reported earnings. We're trying to determine and we focus on normal earning power, which is less subject to significant volatility, which we may see on a quarter-by-quarter basis. We attempt to steer clear of the noise created by short-term accounting unpredictability of underlying firm economics. And we begin this process by identifying initial valuation extremes using relative dividend yield frameworks. RDY, relative dividend yield, is an initial valuation framework that narrows the investable universe to a subset of companies that tend to be out of favor. Dividends are also useful to us from an analytical framework, and Andy will talk about that in a minute. Page number 14 looks at our portfolio investment team. Andy is a portfolio manager, as am I, and we also act in roles of analysts. And Andy and I, as well as our team of analysts, are each responsible for a cross-section of economic sectors. We meet formally on a weekly basis, whereby the entire team on this page gets to sit around the table. The analyst responsible for a particular idea tends to be the champion of that idea, and everybody else around the table tends to play devil's advocate until each question and every question has been addressed appropriately. We're also pleased to announce that in May we will be adding another member to our investment team. In terms of the history of dividends, on the next few pages. Page 16, stock market dividend yield history. This chart simply looks at the dividend yield of the S&P 500 since the turn of the century. In fact, since the year prior to that, since 1999. And by looking at this chart, with dividend yields as high as they've been since the turn of the century, with the exception of the market bottom in 2009, you could see that spike in the dividend yield at that point. We often get questions about how much higher can the dividend yield, on average, really get from here. Investors have really gotten used to low dividend yields overall, is what we would say. And the answer to this question is on the next page. This is the exact same chart as on the previous page. The only difference is that we decided in this case to expand the chart to the last 30 years. A very different perspective. The conclusion is that we're not even half of the way back to where we were at the beginning of the 1980s bull market. We believe dividend yields, on average, are likely to continue to increase meaningfully over time. And there are many reasons for our beliefs, not least of which is that dividend payouts, that percentage of earnings paid in the form of dividends, remains much lower than it has been historically. We also believe that the number of companies initiating dividends is likely to increase over the next few years, not decrease. Page number 18, what are some of the perils of dividend investing? Look before you leap. Dividends are not guaranteed. They are not a promise. They are also not a contract. But for companies that have sustainable and generally predictable cash flows, they are one, for us, an important part of the total return equation, and two, they can be a powerful indication of what managements believe their true underlying earning power to be. What we're trying to do when we look at dividends is to manage through and for the possibility of dividend cuts. We're not necessarily trying to eliminate the risk of dividend cuts. Not all dividends are sustained equally. A slowing dividend growth can be an indication of changing capital allocation decisions, but it can also point to a deterioration in a company's fundamentals. This is a very important point for us. The last one, dividend-wise and principle-foolish. This refers to the analytical framework that's useful to us from a dividend perspective. And a number of studies we've authored over time suggest that it's often wise to steer clear of companies that may on the surface appear to be attractive based on absolute dividend yield. So we're really not focused on absolute dividend yield, tend to stay away from the highest dividend yields and dividend payers for fundamental, analytical, and valuation reasons. And with that very quick background on SKBA and thoughts on dividends in general, I'm going to pass it to Andy Bischel for greater detail on some of the investment frameworks as well as portfolio construction metrics. Andy?
Thank you, Josh. We are, again, delighted to be here to be able to participate with our partners at Azzad in bringing you a perspective on the value side of one of the portfolios that is offered to you as clients. But I would like to say, as we're looking at this dividends done differently slide, that we're not interested in buying dividend-paying companies just for the sake of receiving the dividend. The dividends are viewed quite differently than many advisors might look at them, because we look at them as an important part of our valuation framework, which you can see on the next slide. This valuation framework is something that we pioneered as an organization. We have used this relative dividend yield concept for the entire life of this company, the 25 years we've been in existence, as well as before that. And what we see is that from our view, the absolute dividend yield tells you nothing about the timing, the valuation attraction, or the stability of the price of the security. Furthermore, a high absolute yield, as Josh has mentioned, may become a red flag, not simply a reflection of an opportunity, because it is among the highest dividend payers that most of the dividend cuts emerge. And although we're trying to intelligently manage that process, nonetheless, we think that those are some of the dangerous securities to be involved in. Furthermore, it is also the area where companies that always have high dividend yields tend to be quite subject to the variability of interest rates and become bond substitute-like securities, and we're trying to make sure this portfolio doesn't act like a bond substitute. So used properly, this relative dividend yield ratio is one that we have found that captures the emotional swings of investor sentiment in the marketplace. So let me describe how this might work. As you look at a relative dividend yield ratio, and as it's rising, a stock price is likely to be underperforming the market. But you get to a point compared to its own history where all of that pessimism is now captured in the valuation of the company. At the other extreme, when the price has risen a lot and the relative dividend yield has fallen, then we find that the investors have become optimistic about the outlook. And we get the opportunity to purchase from distressed sellers and sell to eager buyers in the way that we use this indicator. It indicates the right time to buy a high absolute yield, not simply because a company might have a high absolute yield that is offering to investors at any current price. As we advance to the next slide, you can see how this works in the ratio definition. Again, as I said, we pioneered the use of relative dividend yield, and it's built on the foundation that companies do not set their dividend policies whimsically. They set them with an eye to what they can earn and sustain over an economic cycle and over financial market periods of great strength or weakness. And we try to capture this in this RDY ratio that is reflected here, which is a stock's dividend yield at any point in time, divided by a benchmark of our own internally generated, what we call the SKBA Dividend 500. These are 500 large dividend-paying companies that trade on U.S. exchanges that have North American business presence. When we look at how that ratio changes, this is what captures this emotional swing. Again, a high relative dividend yield ratio compared to its history is usually a time when there's pessimism about the outlook for the company. And alternatively, a low RDY ratio at any particular point in time relative to its history is an indication there's optimism reflected in that company's valuation. And so the bottom panel there describes what we're trying to do as the initial valuation filter here. The valuation discipline is designed to identify companies with low expectations already discounted in the price of the stock. And if you advance to the next slide, the reason is that when the board of a company sets this dividend based on the long-term earning power of a company, then it can become a useful and powerful signal about the company's underlying sustained earning power. And Josh spoke about this earlier. And this is true even if the company doesn't specifically articulate a payout ratio target. We're getting an information value out of the dividend policies that others are not looking at in the same way. So here's what we get philosophically. This is the chain. We get a public view into the private mindset of the board of directors and management of a company about what they believe their earning power is by the way they set their dividend policies. And this is a unique application by SKBA towards this thought process. Now, as Josh said earlier, there are several different components and values of total return from the dividend philosophy, and you can see that on the next slide. What we look at is that dividends indeed, we're not focused on absolute yield or dividends per se. Nonetheless, the strategy produces attractive current income for clients that need that. Secondly, there's a source of downside protection in protracted declining markets. And the reason, again, is that we're buying the companies initially when we see that relative dividend yields are high compared to their own history. Again, that's the right time to buy that high absolute yield, and at that point, it tends to provide downside protection if the market is selling off. And as a result, you get less decline, and our whole philosophy is based on if we just don't dig deep holes when the market declines, you don't have to have the heroic returns on the other side of the cycle in order to have attractive risk-adjusted returns over an entire financial market cycle. And there's one third point that should be mentioned there at the same time, and that is that we end up capturing the appreciation opportunity in the company as well. So not only do we get an above-average yield that compounds into quarterly return, but because we're buying a company that is discounted and depressed in its valuation, we get an opportunity for the valuation to mean revert to a higher valuation, giving us a good capital appreciation opportunity as well. And that may be as a result of the reaction to changing internal underlying fundamentals of the company, or the actual change in earnings that is greater than expected from a point of depressed expectations. And every time we see this opportunity set present itself for an individual company or a group of companies in an industry, it challenges us to look at the investment opportunity at just the right time that we should be looking at it. And so if you then look, well, how do we apply this within the specific structure of the portfolio, you can see that as you move forward to the next slide. And we want to look at how the current portfolio is positioned for you as reflected in the target weights on this slide on page 25. But it's not simply the allocation of weights that is what we're focused on here, because we end up, based on your own desired exclusionary screens, we have a very small exposure to what is considered to be the sector of finance and also electric utilities, or utilities in general. And finance is because of your own desires and screens, and because of the leverage ratios in the utility area. But we don't simply then take that information and take that and reallocate the sector weights proportionally among other sectors. What we're trying to do is to position the sector weights so that we create the effective diversification portfolios need and desire. In that financial area, there's only one stock that's in there, and it's really a manufacturer, but it gets classified as a financial, it's warehouser who's involved in the forestry business. As you can look at, however, at this, we're not interested in allowing the portfolio to become too interest sensitive either, and so we're not really reflecting ourselves as a bond substitute. Indeed, if you look at the portfolio weights on a sector basis, you can see that there's a modest pro-cyclical bias here. We are overweight relative to the benchmark in industrials, information technology, and materials in particular. And we're getting some of the defensive characteristics from being overweighted in healthcare. But some of the other sectors aren't nearly as overweighted because, to our view, they're not as attractive as these sectors that we were invested in. So we believe we've created a portfolio of an attractive set of characteristics and attractive construction of the portfolio. If you move to the next slide on portfolio construction. We believe that we're able to accomplish this with 30 to 40 stocks in each portfolio. And it creates this desirable set of characteristics. But we do have some control measures that we utilize here. One, we're looking at a large cap universe. Secondly, the companies have to pay dividends. Third is that as we look at the sector weights, we're willing to go up to 3 times or 15% at the time of purchase. But because we limit the individual holding of a security to no more than 5%, one of our goals is to not allow any particular security's negative surprise, for example, to torpedo the performance of the overall portfolio. These days, with the volatility of individual underlying stocks, we all know that a 2-cent earnings shortfall in a quarter can cause a significant stock price decline. And so we control some of that risk as a result of having this constraint of not owning more than 5% in any one security. In addition, if you look down, the time horizon that we have is 3 to 5 years as our typical holding period. So this is a low turnover portfolio. It is not new idea intensive, even though we're constantly looking for new ideas. And the target turnover ratio is typically only 30 to 35%. As a result, we've been able to produce the attractive rates of return in the portfolio as a whole. And so we would like to offer you this summary of the value proposition on the next slide that we believe we offer to clients. We're building perspectives that are different than Wall Street. We're not trying to replicate what they do, and relative dividend yield as an initial valuation filter is just one example of that. We have implemented this process over numerous economic and market cycles and has proven itself to be repeatedly successful in delivering desirable investment attributes to our clients. The process allows us to buy companies with low expectations already discounted into the price, and that gives us the creation of upside opportunities for capital appreciation. The added plus is the relative dividend yield that compounds into return and produces an above-market yield and source of income. And we seek, as a result, to produce attractive risk-adjusted returns over a market cycle while attempting to minimize the permanent risk of loss in bear markets. And you can rest assured that our interests are aligned with all those of our clients, both because we are owners of our own business and we are owners of the various strategies we manage for clients. And we're happy to entertain your questions.
Okay, so with that, the official portion of today's webcast is that we've intentionally built in a little time for questions and answers, and you can do that one of two ways. The first is to type a question in the chat function of join.me on your screen, or you can also unmute your phone line using the *6 command. And I will take the presenter's prerogative and go ahead and ask a quick question of our experts regarding the SKBA Dividend 500. You guys mentioned it briefly. I was wondering if you might be able to elaborate on it, because it sounds like that's sort of, in many ways, a crucial component of your unique selling proposition. And I know you use that for the strategy you manage for us in the ethical wrap program.
Yes, Josh, that is correct. And when we created that, what we're trying to do is to create a tool that helps us differentiate among the traction of dividend-paying companies. And so the S&P 500 itself has a lot of non-dividend-paying companies. So we decided quite a long time ago, more than a decade ago, to utilize our own internal benchmark of the yields that are available from other dividend-paying companies that trade in the U.S. markets and have a North American business presence. And we believe that then gives us an opportunity to say, here are the alternative dividend yields that you might capture by owning any particular company. What is the dividend yield of Company A we were considering for purchase relative to that broad universe of dividend-paying companies compared to its own history? So it's really what allows that ratio to capture, when the ratio is high, capture this sense of it's out of favor, both compared to its own history and compared to overall companies overall in that universe of dividend payers. We rebase that universe annually and update it monthly. If a company is acquired and disappears, we have its replacement chosen in advance as to who would go into that. So we always have 500 companies that we're watching and also using is the denominator of that ratio.
Great, thank you. And anybody else out there in the audience? We do have a little bit of time left. Feel free again to unmute your phone using the *6 command function, or anything in the chat box. I'll check once. And if not, we will be mindful of everyone's time and perhaps get out of here a little bit early. 3, 2, 4, not anymore. All right. So with that, that's going to conclude today's presentation. Special thanks to our guests at SKBA Capital Management, as well as Harris here at Azzad. Thank you all. Just a note to those callers today, please visit our websites at azzad.net and azzadfunds.com for more information. At azzadfunds.com, you can download and read a copy of the prospectus for the Azzad Funds. The prospectus contains more information about the fund's risks, expenses, and investment strategy. While there, you can also sign up to receive our monthly e-newsletter at either of those websites, in fact, to get more information about our process here at Azzad, as well as our other products and services. Finally, be sure to follow us on Twitter. The handle is @AzzadFunds. And let me also note that a recorded version of this presentation will be posted to our YouTube channel. That's youtube.com/AzzadFunds in the next few days. So be sure to take a look. That's it, everybody. Thank you again for your time, and have a great afternoon.
Thank you.